Picture a stream of income that grows year after year, providing you with a cushion against financial uncertainty. Welcome to the world of dividend growth investing. Imagine this. You're an investor and you've got your eye on a company. You buy shares in that company, not just because you believe in its vision, but because it regularly rewards its shareholders with dividends. These dividends, a portion of the company's earnings, are like little thank you notes expressed in dollar terms for your faith in the company. But here's where it gets exciting. Some companies do not just distribute dividends, they increase them over time. This is dividend growth investing. It's like having a tree that bears fruit every year. Only the tree keeps growing, and so does the fruit it bears. The power of dividend growth investing lies in its potential to provide exponential income growth. Every year, as the company grows and profits, it increases its dividend payout. You, as an investor, receive more dividends than the previous year. And if you've invested in multiple such companies, you can see how this can quickly add up, creating a snowball effect of wealth accumulation. Moreover, these steadily increasing dividends can be a buffer against the volatility of the stock market. They offer a steady, growing income regardless of the market's ups and downs. In other words, even if the market is having a bad day, or even a bad year, your dividends keep rolling in, and they keep growing. But the real magic of dividend growth investing happens when you reinvest these dividends back into buying more shares. Over time, this cycle of buying shares, earning dividends, and reinvesting them creates a powerful compounding effect, leading to exponential growth in your wealth. So, how does one tap into this potent wealth creation strategy? Let's dive deeper. Before we navigate the path of dividend growth investing, it's crucial to understand dividends. Now, what exactly are dividends? Picture this. A company is a big cake, and every slice of this cake represents a share. As a shareholder, you own a slice or multiple slices of this cake. When the company makes a profit, it decides to share a portion of this profit with its shareholders. This portion is what we call a dividend. Dividends can be distributed in two forms: cash or additional stock. Cash dividends are like getting a piece of the profit pie directly in your bank account. Stock dividends, on the other hand, are like getting an extra slice of cake, increasing your ownership in the company. It's important to note that not all companies distribute dividends. Some prefer to reinvest their profits back into the company for further growth. With a firm understanding of dividends, we can now explore the steps to successful dividend growth investing. The first step on this journey is selecting the right companies. Now, this might sound straightforward, but it requires a keen eye and diligent research. We're not just looking for any company that pays dividends. We're hunting for those with a consistent track record of regular dividend increases. Why is that? Well, a company that regularly increases its dividends is typically a sign of financial health and a strong business model. It's a signal to investors that the company is confident in its future earnings, and it's this confidence that will help you, the investor, build wealth over time. However, it's not enough to simply pick a company that has increased its dividends in the past. You need to dig deeper, investigate their financials, look at their earnings, debt levels, and payout ratios. Do they have a competitive advantage in the market? What's their long-term growth strategy? Remember, investing is not about quick wins. It's about long-term sustainable growth. And where might you find such companies? Well, there are certain sectors that are known for their dividend growth. Let's take utilities, for instance. These companies often have stable cash flows and are less affected by economic downturns, making them a reliable source of increasing dividends. Or consider consumer staples. These are companies that produce goods people buy regularly, like food, beverages, and household items. Regardless of the economic climate, people need to eat and clean, right? As a result, these companies tend to have steady earnings and, consequently, regular dividend growth. Healthcare is another sector to consider. With an aging population and advancements in medical technology, healthcare companies often see steady demand and strong profits. This can lead to regular increases in dividends for investors like you. But remember, While these sectors are known for their dividend growth, it doesn't mean every company within them is a good investment. That's why thorough research and due diligence are so crucial. Choosing the right companies is the foundation of dividend growth investing. But there's more to it, and we'll get into that in the next scene. So stay tuned. The second step is reinvesting dividends. Now, this may sound straightforward, but there's a world of strategy and potential behind this simple phrase. Reinvesting dividends is essentially using the dividends you receive to buy more shares of the same stock. This creates a snowball effect, where your investment grows not just from the increase in share price, but also from the increasing number of shares you own. Imagine a snowball rolling down a hill. As it rolls, it picks up more snow, growing larger and faster. That's your investment with reinvested dividends. The dividends are the fresh snow that the snowball picks up, making it grow larger at an increasing rate. This is the compounding effect, a powerful force in the world of investments. Now, you might be thinking, that sounds great, but how do I do it? The good news is, many companies offer what's known as a dividend reinvestment plan, or DRIP for short. A DRIP is a program that allows investors to automatically reinvest their cash dividends into additional shares. Enrolling in a DRIP has several benefits. First, it's automatic. You don't have to remember to reinvest your dividends. It's done for you. Second, because you're buying more shares, you're increasing your potential future dividends. Remember, more shares mean more dividends, which in turn means more shares, and so on. It's the snowball effect in action. Finally, and perhaps most importantly, DRIPs often let you buy shares without paying any brokerage fees. This means every cent of your dividends is going to work for you, not for a broker. To summarize, reinvesting dividends is about using the dividends you receive to buy more shares, which then generate more dividends, which buy more shares, and so on. This compounding effect can significantly accelerate your wealth creation, making your snowball grow larger and faster than you might think possible. Reinvesting dividends is a powerful tool to accelerate wealth creation. Let's move on to the final step. The third and final step is perhaps the most important: patience and consistency. When it comes to dividend growth investing, the journey is often a marathon, not a sprint. You see, the power of this investment strategy lies not in quick gains and short-term wins, but in the slow, steady accumulation of wealth over time. Long-term investment is the key to unlocking the full potential of dividend growth investing. Every dollar you invest today is a seed planted, a foundation stone laid, and just like a seed needs time to grow and bear fruit, your investments need time to mature and yield dividends. The power of compounding, where the returns on your investment are reinvested to generate their own returns, is a powerful force in wealth creation, but it doesn't happen overnight. It takes time, takes patience. But patience alone isn't enough. Consistency, the act of regularly investing, is just as crucial. It's like watering your garden. You can't just water it once and expect it to flourish. You need to water it consistently. Similarly, to grow your wealth, you need to invest consistently. It doesn't matter how much you invest each time. What matters is that you do it regularly. This gradual, consistent investment helps you build your portfolio, brick by brick, over time. The beauty of dividend growth investing lies in its simplicity. You don't need to time the market or make risky bets. You just need to select the right companies, reinvest your dividends, and then sit back and let time and consistency work their magic. It's a slow, steady, and reliable path to wealth creation. But remember, while this strategy is simple, it's not easy. It requires discipline, patience, and consistency. It requires you to resist the temptation of quick gains and stay the course, even when the market is volatile and uncertain. But if you can do that, if you can remain patient and consistent, then you're well on your way to building substantial wealth through dividend growth investing. With patience and consistency, the magic of dividend growth investing unfolds. So, to wrap up our journey into the world of dividend growth investing, first, we learned that selecting the right companies is crucial. Look for those with a strong track record of stable earnings and consistent dividend payouts. These are the enterprises that are likely to reward you with a regular income stream. Next, we explored the power of reinvesting dividends. By plowing these payouts back into buying more shares, you're essentially compounding your investment. Over time, this can lead to exponential growth, turning a modest initial investment into a sizable nest egg. But perhaps the most important lesson is the value of patience and consistency. Like a fine wine, a dividend growth strategy takes time to mature. Consistently investing, regardless of market conditions, and patiently waiting for the magic of compound interest to take effect is the key to success. Embrace the power of dividend growth investing and unlock the door to sustainable wealth creation.